an application-only event in which we'll only select a few students, and it'll be very small scale. So we'll get 4 to 5 students and we'll get a consultant in each room. So within the span of 1 hour, you can meet 4 to 5 consultants in a very small setting. So you can actually make an impression and ask any questions that you might have. So that's only for women. It's you can find it on our Facebook page. And the last event I would like to flag is, this hasn't been finalized yet, but we are doing a consulting with social impact event with one of the consultants at the World Bank, and that will most likely be in week 9. So keep a look on Facebook for that. So those are the 3 events that we are hoping to host in the near future, and I think that's about it. So, Alex, if you could get started. And of course, Alex has been very kind today to offer her time. So we hope that this is really useful for everybody.
Yeah, I hope it is useful for you guys. So my name is Aleksandra, and I went to Warwick myself a few years back. I graduated in 2017 from management with finance, just an undergrad, and then I joined FTI Consulting, and in particular economic and financial consulting departments straight away after I graduated on a grad scheme. So that makes it 3 years in FTI for me so far. And yeah, so far so good. So today I'll just tell you a bit more about what we do and generally about economic and financial consulting. And I would like to show you main valuation techniques, and then tell you a bit about how we use them in our line of work. And then finally, we'll wrap it up with some overview of opportunities at FTI and in economic and financial consulting specifically. I have sort of last bit of the agenda reserved for questions, but if you have any questions throughout, feel free to shout. I don't know if we have a chat function, but however you want to voice them in the virtual environment, just feel free, go ahead. All right. So to start, I think it might be worth to actually tell you what we do in economic and financial consulting in FTI, because I appreciate it's very much not obvious. So the main thing, our main practice area are claims and disputes. And what we do is we value damages in legal conflicts. I appreciate that might sound a bit complicated, but what it is in essence is, if you imagine there are 2 leading mobile phone producers, and one of them alleges another one of stealing their phone design, and they decide that they're losing money because of that, and they will sue the producer that allegedly stole the design. We are the people who will come up with how much they're suing for. So it is valuation, but just in a bit of a different context than you might come across usually. So that's the main bit that we do. We also do economic regulation and policy, and that's consulting in regulated industries. So regulated industries are sort of the key, most strategic industries, such as telecoms, transport, energy, and they are usually governed by some additional regulations as opposed to, sort of less strategic business areas. And we help both companies operating in these industries to operate in them, facing these extra regulations and still be profitable. And also from the government side, we help them prepare the regulations which will allow, for example, consumers to have electricity that they can afford, but also businesses to make enough money to stay afloat. So for example, thinking about allowed price that electricity suppliers can charge is one of the examples of questions that we would face in the economic regulation bit of our practice. And then finally, we also do a bit of non-contentious valuation, which just means valuing assets, companies, projects in non-legal and non-dispute environment. If you are not speaking or don't want to ask any questions, I'd appreciate if you could mute, because there's a bit of sort of echo and the background noise. Thanks. So from what I've said so far, you might already get the idea that we're a bit different than more I think more widely known types of consulting, like strategy and management consulting. So we sit more on the specialty consulting end of spectrum. And I think I wanted my message today to be that there's probably a lot more types of consulting than you might realize. At least there's a lot more than I realized there are at uni. And I think in FTI Consulting in general, we have we sort of put together groups of people who are specialist consultants. We don't do much of strategy or management consulting in any of our departments, but we're sort of a bunch of groups of people specializing in different things. So I'm going to talk about economic and financial consulting in particular today, but towards the end I might touch upon other things that we also offer in FTI, but you can have things like PR consulting, financial consulting, technology consulting that I think is potentially a bit more well known. And as much as these types of consultancies are different, and the questions you're answering are more specific, as you can see on the slide, they still do have the sort of classic characteristics of consultancy. So you work on your work is project-based, you work on different projects, you work in different teams. The problems that you solve vary, you need to learn quickly, sort of with progression, your role changes from more analytical role, whatever the specialty is, to more managerial role where you manage people, projects, client relationships. All of that is similar, and that's why we are under consultancy umbrella, but the focus of the work is slightly different. So as I indicated before, our focus is valuation, and then you can do valuation not only in financial consulting, but also in other areas of business. So the one that I think was at least most well known to me when I was at uni was transactions. So in essence, what we do is we value how much companies are worth, which is what you might expect banks to be doing. Especially the sort of investment banking departments doing mergers and acquisitions and initial public offerings. All of them are involved in similar processes and use quite similar techniques to us, just in a different context. Then another context is lending. And I think it's people who do corporate finance that deal with lending mostly. And it's sort of just ensuring that the company will be able to pay off its debt. And then economic regulation, that's what we also do. But what we will focus today mostly are disputes. So the disputes are usually, especially business disputes, are usually resolved through some kind of monetary compensation, and you need someone. If the case is complicated, lawyers are usually not able to assess the losses and damages themselves. Therefore, additional support in the form of financial consultants are hired to value these losses. Oh, right. So my PowerPoint just crashed. Well, I'll bring it up again. The next slide is just about us sort of day-to-day dealing with quite interdisciplinary problems, sort of working in areas of accountancy, economics, but also law. That being said, I want to stress that people working in FTI, in economic and financial department, usually have very little knowledge of law, and our expertise doesn't lie in knowledge of law. It's in the valuation. However, we do work in this context, and it sort of damages are definitely connected to legal issues. All right. So, if no one has any questions about sort of what financial and economic consulting is in general, then I'll move to the main bit of today, and give you a bit of background on valuation techniques that we use in our work day to day. But as I said, these will be the same valuation techniques that are used in other contexts, such as transactions lending, etc., etc. So first of all, when you have to value an asset, a company, whatever it might be, you probably should start by thinking, what are the drivers of value of this thing? So maybe think about sort of buying new car, and let's think about valuing a company at the same time. So what drives the value? So first of all, expectations of future performance. So there are better and worse cars that will be faster, slower, consume less or more petrol, etc., etc. And then similar with companies, there are companies which will generate massive profits, and there are companies which, are sort of small businesses, sometimes not profitable at all. And obviously such business will be worth less than a business which is expected to generate loads of money. Then uncertainty around the expectations. So for example, is your car theoretically great and supposed to, you can drive really fast and all that, but it's a bit old and you're not sure if it's not going to break in a few months. Obviously, such car would be worth less than the car where you're sure that it will perform well for years. And similar with companies, is it in an industry that's uncertain, might shrink? Is it in an industry which is not very big currently, but might grow significantly? but is it sure that this industry will shrink or grow? All of these things impact value. The more sure you are that something will do well, the more money you should be willing to pay for it. And then finally, alternative investment opportunities. So you usually have a finite amount of funds to invest. And you need to decide whether you invest in one or another company. And if the other opportunities are scarce, then you might be more willing to just pay for that company. However, if you've got other better opportunities, then value of this one suddenly decreases. And it's like that with cars or any other products. If there's a lot of them on the market, you're able to choose from loads and you don't have to overpay for something mediocre. But if there's not really that much available, then you just have to get on with what you can have. And and then the value of stuff, of products or companies increases. So these are the drivers of value. But how do we quantify them? How do we come from the drivers of value to the actual valuation? Oh, I sense, yeah. Abby, I'm not sure. Maybe it would be actually better for someone else to share the slides.
Okay, sure. So I have sent the slides to Adeswa, but I think I gave her the longer version. So Adeswa, if you could pull that up, and then if you want to go through anything, just give her a shout.
Yeah, sure. Sorry about that. I am not sure why my computer cannot handle sharing the slides and being on Zoom. Thank you. Yeah, I think we actually are past the bit that I cut out.
Yeah, I think. Yeah, there you go.
If we could just go to slide 13. Perfect, thank you. All right, so sorry about that. And coming back to what I was saying. So there are generally three main valuation methods. And one of them, so it's comparables, cost-based methods, and cash flow methods. So comparable methods is just basically valuing something, looking at things that are similar. So I think that's quite common in sort of in valuing, or I guess you would use word pricing, of products and things we sort of deal with day to day. I assume that if you were to sell something, I don't know, your old laptop on eBay, you just look how much usually people sell these kinds of laptops for. And you can do the same with companies. So usually what we do is we look for similar companies which are publicly listed, because companies for which are publicly listed, we can get more information for them. And also they're traded every day on a public market. So we have information on views of investors on the value of such company every day. This value being basically reflected by the share price. Also, similarly, you can look at the previous transactions. So if you know that a company in a similar industry has been bought or sold not that long ago, you can use that to understand more about the value of the company you're looking at. Then the cost-based method. Sorry, there's a bit of echo. Yeah, I think we're good now. So the cost-based method is based on, well, as name suggests, on how much was spent to develop the company. So if you imagine, for example, a solar power plant producing electricity, how much a solar plant like that is worth, you can just look how much money was spent on all of the buildings, equipment, solar panels, land where it's built, and just add all of these things together and say, well, it's worth X amount of money. This is usually quite easy, but it's also quite simplistic, because business is usually worth a bit more than just assets that it owns. And that's because it's supposed to generate money in the future. It's supposed to have opportunities to grow. And it has value of intangible assets. So, well, it's maybe not that much applicable to a solar plant, but very much if you have a business where branding is important, such as, let's say you own, I don't know, a fashion retailer, you're worth a bit more than just the value of the clothes you have sort of in your storage facility, and value of the shops you own, because you have a brand and other intangible assets like that. Therefore, the cost-based valuations are usually assumed to be sort of the floor, like the minimum value, and valuers usually appreciate that businesses are worth more than that. And then finally, I think possibly the most widely used valuation method, and the one on which we'll focus a bit more today, is the discounted cash flow method. So it is based on projections of how much a company will make in the future. So if we come back to our solar plant example, you just think about revenues and costs, or to put it differently, cash inflows and outflows, and you think how much cash this company will generate each year going forward. So to look into that in a bit more detail, can we look into another slide, please? So what the sort of discounted bit of the discounted cash flow is accounting for a time value of money. So I'm going to try to explain what the time value of money is based on an example here in the slide, and then we'll come back how it ties into a discounted cash flows model. So imagine you had a house, but it very sadly burned down. And now you have a vacant plot of land worth £50,000, and you were also likely insured. So you also have £300,000 from your insurance. So initially you thought, all right, I'm just going to rebuild my house and all will be good. But you have a real estate advisor who contacted you and now says, right, you could build your house, but you could also build an office building, and then in a year I can, for now let's assume, guarantee that you will get 400,000 for this project. So how do you decide if it's a good project? How do you decide what are the costs and what are your future revenues or cash inflows? Does anyone have any ideas?
I think for this, if you just want to type into the chat, or you can raise your hand, that works as well. Nobody asks, then you can call on someone, or if you feel mean, but it's up to you.
No, that's fine. That's fine. I'm happy to just tell you and not call out on people, definitely. So in terms of your costs, you obviously will use the money you got from the insurance for the construction, so the £300, and you'll use the land that's worth £50,000 for that as well. So you should add those two values together. And even though you already have the land and you don't really need to spend any extra money on it, you should include it, because if you don't decide to pursue this opportunity, you can just sell it, and then you're going to have 350,000 in cash. So always include everything. And then, so these are your costs. And then you know you're going to get 400 in a year, but how much is 400,000 today? What is the how do you decide if it's worth to freeze 350 today to get 400 in a year? So if we could move to the next slide. So here comes the idea of discounting. So you can also consider an alternative scenario. What else can you do to get £400,000 in a year? Well, one of the options you have is investing in the UK bonds. And since they're backed by UK government, which is quite unlikely to go bankrupt, well, maybe more likely now in COVID times, but still pretty unlikely, we assume that bonds issued by governments such as UK, US, German, and other sort of countries considered quite strong economically are risk-free. So to certainly get 400,000 in a year, you can also invest a certain smaller amount of money in these government bonds today. And here in this example, we assume that the annual rate of return on government bonds is 5%. I'm sorry to break it to you, these days are gone. It's a lot less nowadays. But let's keep it 5% for simplicity. I doubt that you would even get one now. So this calculation that you see on the slide, 400,000 over 1 plus 5%, gets you to how much you'd have to invest today to get 400,000 out of these bonds in a year, and it's sort of quite simple maths in reverse. So 380,000 times 1 plus 5% will get you 200,000 in a year. So to get it the other way around, instead of multiplying, you're just dividing. I hope that's clear. If not, then shout or chat or whatever. And then, so you now know that 400,000 today, in this alternative scenario, when you decide to invest in the UK government bonds, today is worth 381,000 approximately. And your project, your sort of convert my burn house to an office space project, is only going to cost you 350. So it looks like you're going to make some money. And how much money you're going to make in terms of present value is the present value of what you will get in a year. So the present value of this 400,000, which we calculated based on the UK government bonds, less what you actually have to pay today. So 350,000. So it looks like you're making around 31,000K, which might give you a suggestion whether you should go ahead or not go ahead with the project. I'm going to give you another chance to shout if it's not clear. And if
I think we're also going to post, if it's okay with you, we're going to post the slides in the chat later so that people can review it if they're confused about anything. Okay.
Yeah, absolutely. All right. So if you could move to the next slide. So there is a bit of a flow and simplification in the example that we just discussed. So we have assumed that there's no risk involved whatsoever. I said that the real estate agent guaranteed that you will make 400K in a year from this project. That rarely happens in real life. There are several theories about risks and returns. The modern finance consensus is that investors will generally take additional risk only if they are getting additional return. So if you're faced with a choice between 400,000 in a year that you will get definitely, and 400,000 in a year that you might or might not get, you are more likely to just go for the certain money. And then how do you account for it? Well, you just assume I think I'll touch upon it a bit later. But to account for it, you just need to apply a higher discount rate. So we're talking about 5% return on quite certain UK government bonds. But if you are to invest in something a lot less certain, then it's more likely to have a higher discount rate because you will require higher return for something that's less certain. So therefore, when you're calculating the present value, you won't be dividing by 1 plus 5%. Maybe you'll be dividing by 1 plus 7. And it's a whole different story how you calculate the discount rate. And I don't think we'll be able to get into it today. But that's the premise. The higher the risk, the higher the discount rate, and the lower the value today of cash flows that are uncertain in the future. I hope that's at least somewhat clear. I just touched upon it, but yeah, it's difficult to explain it properly without sort of getting to too much detail. All right, so if we could move to another slide, where we're coming back. So I just gave you this huge lecture, and now we're going to come back to the discounted cash flow finally. So what do you have to do to calculate a discounted cash flow and value a company based on the discounted cash flow? First of all, you need to have a think about the future inflows and outflows to the company. So imagine you want to buy a little grocery store sort of down the road. How much would you pay for a grocery store like that? So what you would do as a valuer, you'd look at how it did last year. How much money did it make? How much money did it pay? It makes money from selling products, but maybe it has like an employee, so you have to pay the salary, you have to pay the rent. You add everything up, subtract the costs. Let's say it made 10,000 last year. All right, you've got a sort of your base case scenario. Now you have to think about growth. Is this shop going to do better or worse in the future? Is it going to be sort of eaten up by a Tesco's down the road, or is it going to, do even better because there's an increasing trend of consumers shopping in convenience stores because they can't be bothered to go to the supermarket because they don't have time. So you think about things like that, and you need to make a view whether you think the business is going to grow, shrink, the prospects are better or worse. And then, as you see on the slide, let's say you think about the cash flows for the next 5 years. So you start with 10, and then you decide it's going to do, 10% better every year. So you start with 10, then you have 11, and then so on and so on. But we know that from our burn house example, that 11,000 in 2 years is not worth 11,000 today. It's worth less, because you can have 11,000 in 2 years by investing less, for example, in the UK government bonds today. So you need to go through the process that we've seen and discount all of these cash flows year after year to get to how much they are worth today. And then to get to the value of the company, you just add it all up together, and then that's your valuation. That's basics of the discounted cash flow model. Yeah, as I just said before, you probably wouldn't discount it by the rate of return on the government bonds, because having a shop is probably a bit, an investment in a shop is probably a bit more risky than investing in one of the more stable world economies. So you'd probably add a little bit to the discount rate. Someone has asked how could you justify your view on growth? So that's where you become a classic consultant. You just do loads of research about an industry, and you try to find out about trends. You talk to industry experts, you read the industry reports, you use some general forecasts on how the economy as a whole will do in the future, and that's how you justify your growth views. So we also do a lot of research into sort of how industries are looking and on the outlook for industries. All right, if we could have a next slide, please. So that's basically what I just covered, sort of spelled out more explicitly. Yeah, you just need to think about revenues, costs, growth, and then the risk. And then if we could have the next slide. Yeah, and that's something I touched upon before about the discount rate. And as I said, it's the whole new topic. But to find the right discount rate, you need to find something that's similar to your investment. So if something is quite certain, then things like government bonds are okay. If something is less certain, maybe you're looking at corporate bonds, which are considered a bit more risky, because as much as, I don't know, Coca-Cola is a huge company and probably that it will go bankrupt in the next few years, probably low, then it's still higher, I guess, than the probability that US will go bankrupt. And then if you're looking at even more risk, you're looking at even different securities. But generally, the idea is that you try to find something that's similarly risky and that you know the return of, and then use that as your discount rate. All right, so that's all I have for this section. So I've seen that the person asking about growth said thanks, but if you have any follow-ups, then feel free to shout, chat, or whatever, or any other questions. Also feel free to type shout. If there are no questions, then we can quickly move to the valuation of damages. So if we could move 2 slides. Thank you. So what are damages? Basically, damages in legal disputes are supposed to put you in the same position as if the thing that was illegal never happened. So if you imagine that you're one of the leading phone makers and someone stole your phone design, you think, well, I had such a great design, everyone would buy my phone and I would have 30% market share. But then they stole my idea and they have 10% market share. So I lost my 10% market share. So you're trying to get the money that would have put you in the same position as if you had actually the 30% market share in that example. So how do you get there? If we could have another slide, please. So you actually usually do a valuation, 2 valuations, one sort of imaginary in a bad for scenario where nothing bad happened, no one stole your phone design, everything was as planned. And then you do another valuation in the actual scenario where the breach, as we call it, has occurred. So if we think about phones again, let's assume this design was stolen 2 years ago. So you first, and you're building a discounted cash flows model, so you need to think about cash flows. So you think, well, my cash flows in the last 2 years would have been higher because I would have higher market share. So you model these historical cash flows. Then you think about your future cash flows in the bad for scenario, and you think, well, sort of in the future, my cash flows would also be higher because I would have higher market share going into the future as well. And then you're looking into what's actually going on in the actual scenario. What has happened? This is the only thing on a project that you actually know. You have the historical financial results, you look how much money they've made, and you know in the past 2 years they had 20% market share. But you also have to forecast what will happen in the future. So now they have 20% market share. This other phone that's pretty similar exists. So they'll probably continue having that market share. So you do a valuation of company sort of without the illegal thing happening, without the breach. and you do the valuation of the company in the actual scenario. You subtract the actual from the bad for, and these are the damages. This is the lump sum of money that you get that should put you in the same position you would have been. And then if we could have the next slide, you can also present it in a graph. So on the x-axis, you've got time, and on y-axis you've got cash flows. The act of omission is when they stole your design. And yeah, your cash flows sort of plummeted because people started buying the other phone, but they should have sort of go straight ahead. And then date of the trial or hearing, let's say that's today. So that was already happening in the past, but you expect that this thing will keep on affecting you in the future. So you project that your cash flows are still going to be depressed going into the future because of that thing that happened, that because of that competition stealing your design. And the loss is just the difference between these things. And since it is often based on the discounted cash flow model, then these cash flows are discounted. Because if you get the money for your losses today, you can invest them in, well, UK government securities or other securities, or you can start another company, you can do whatever. But this money today, if you're going, the court will order your competitor to pay you that today, you're going to be paid a little bit less than what you would have got in 10 years. Because as we discussed before, £1 today is better than £1 tomorrow. All right, and then if we could...
Sorry, Aleksandra.
Yeah?
I feel like we were kind of running out of time. So do you want to go through career opportunities? And if we have time, we can circle back. Just because I think that career opportunities are quite important for our students.
All right. All right. So what we went through was a case study that we might come back to. It wasn't particularly complicated either way, but yeah, in terms of career opportunities. So what if there is a dispute on how damages are calculated? All right, I'll come back to that in a sec, but that's actually a really really interesting question. All right, so FTI Consulting, we're an American company listed in the US on New York Stock Exchange. We've got offices in over 80 cities around the world. As you see, we've got many employees and 5 different departments. So I don't think I've got time to actually tell you a lot more about the other departments, but just go on our website if any other sounds interesting for you. I know they all have graduate schemes, not sure if they all have summer internships, but they might, so feel free to research that further on our website. If we could go to slide 30. And then, so that's about economic and financial consulting specifically. What do we offer? Some highlights. I already told you about the type of work that we do. So we offer challenging projects in that area in wide variety of industries. People generally don't specialize in any industry early on. We offer competitive salary plus bonuses and benefits. There's a well-defined career path, so generally you get promoted every year, and some of the promotions are like little promotions from consultant 1 to 2. There are also bigger promotions where you change your title, but you generally keep on progressing, and we appreciate that people who are with a company sort of, a year at 3 years are probably a bit more experienced than people who have just joined, and that's reflected in the responsibility, but also benefits such as salary. You'd be working with young and growing practice. I think there's loads of young people and there's loads of very diverse people in our practice. And I think we're quite a fun bunch, as much as you can be for people who like, accounting and numbers and all of that. We have pretty good social program. We've got, well, in COVID times, maybe less so. We've got loads of virtual fun, but hopefully soon we'll come back to our normal social calendar with loads of socials. And one of the perks is, for example, yearly away day in Portugal, where we go for a weekend to a nice hotel at Portuguese seaside and just get to know each other a little bit better, spend a bit of time together, and have a bit of fun. So additionally, everyone joining us on a grad scheme is sponsored through their ACA or CFA program. So that's Chartered Accounting qualification or Chartered Financial Analyst qualification. So you get a lot of opportunities to learn, grow, and also good study leave to allow you to actually do it and have a life as well. I think we're generally quite good with workers. Of course, the salary is competitive and it's a competitive industry. So it does happen that we work later, but we try not to, and we don't work too many weekends. I think in my first year, maybe I worked one weekend. So that might give you some kind of an idea. And it's not, people just don't really stay past midnight or anything like that. It's not like in banking that it's a bit tougher on work-life balance. We've got a lot of volunteering opportunities. I think I'm going to talk about it later. And then, yeah, we've got some opportunities to work abroad. As I said, we've got offices in many places, and you can go on secondments as close as Paris or as far as Hong Kong or US. So there are some opportunities for that. If we could have the next slide. Well, as you might sense from that session, we're quite committed to bring more diversity into our team. And we also have some diversity networks. We have Black, Asian, minority, ethnic network. We've got Women's Initiative, LGBT plus network, and Mind and Body network, which is around mental well-being and mental health issues. If I could have the next slide. We're also doing a lot of around corporate social responsibility. So we have Charity Partner of the Year, which is sort of FTI-wide charity that we raise money towards for the whole year. And that was WCS this year, but we're going to change in 2021. And then we have some pro bono projects. I can tell you very quickly about Experts in School. So that's in non-COVID times, we've got students coming to our office and we're teaching them about basics of economy to try to sort of make them more immune to the fake news that are spreading everywhere. We try to teach them that if a government spends more on NHS, then it needs to spend less somewhere else or raise taxes, and sort of about basics of economy or economic cycles, just so they're a bit more aware and a bit more immune to the fake news. So I think we can maybe skip the next slide and go to the application process. So the application process, this is for the graduate scheme. And for the summer internship, it's a bit shorter, I think. And for the Insight Day, I think it's quite different. It's probably just an application without interviews. But the fullest process that we have for graduates is starts with online application where you submit your CV. There are a few motivation questions, and then you take a culture fit assessment where we just assess if we're going to fit our bunch. And then you move to the online tests. There's verbal, numerical, and diagrammatical reasoning tests. We then have a video interview, which is not like a pre-recorded video interview. It's an interview with an actual sort of person live, but just through a video, so you don't have to come to our office, which is quite convenient this year because the office is currently closed. So, but we are planning to retain it a video interview in the future years if you're planning to apply next year, for example. And then there's an assessment center with case study based on what we do, group exercise, and then interview with a senior member of the team. If I could have the next slide, please, with the deadlines. So you have key dates on the right. Our deadlines this year have been moved to, well, our graduate scheme deadline has been moved to the end of January to give ourselves and everyone else a bit more time in this odd year. But yeah, they're both applications for both graduate scheme and summer internship are open. We are hoping to have an Insight Day for first year students in spring 2021. More details to follow in early 2021. I think just look out on our website. We'll try to also let the Consulting Society know when we're open. So you might also follow their channels for that, but have a look at the website. Tips for the initial.
Sorry, could you let people know, is it a rolling application or is it just you only look at applications once they're submitted and the deadline has passed?
Sure. So we do look a bit earlier at some applications, but in principle it's not rolling. So it's fine, they're open and you can apply a bit later as well and your application will be reviewed. I'm not recommending this, but I applied on the deadline. So they are not really rolling. We might start looking earlier. So if you want to get an early interview, then feel free to apply now.
Yeah, I think that's really good because it comes after the banking applications close. And I'm sure a lot of people here can see that it's quite similar to investment banking, seeing its comparables in DCFs. So, you know, definitely apply if you're interested in investment banking or consulting or both.
Yeah, and that's all from me. There is this one question about how damages are calculated that I can address, but also I appreciate it's time to go. So if you guys have to go, I won't hold it against you, and feel free to absolutely drop off. But if people have questions and if anyone who's the host is able to stay another 5 minutes, then I'm happy to answer to any questions, to that question that I have and any other questions that you might have. So feel free to stay, but also absolutely feel free to drop off. Is that okay, Abby?
Yeah, that's completely fine with me. Adeswa, can you stay? Because she's still not staying.
Yes, I'm fine to stay.
Okay. Yeah, well, thank you so much for staying over as well. And me in general as well.
No worries, no worries. So the question was, what if there's a dispute on how damage is calculated? Well, there generally is a dispute. There usually is a dispute on how damages are calculated, and that's because we're usually appointed as an expert to one side, a bit like a legal team. We're working for one client and not the other. And it's a whole different topic, but we can't just say things extremely sort of from the top of our minds and just make the case as good for our client as we want to. We need to be independent, and then this reputation of our firm sort of on the line for not being independent. But on some things we take advice from legal team, for example, and they instruct us on what's legal and illegal, and the legal teams of two sides usually disagree on these issues. So based on different instructions, the experts, because that's what we're usually called, experts appointed, sort of value experts appointed on both sides, come up with a different answer. And then in a legal dispute, there's usually like a separate stream where we have our own little dispute about the valuation with the other expert. So it's quite an exciting angle of our work, that there's someone looking at what you're doing, sort of looking at how you calculated things, trying to find mistakes, trying to say, that's wrong. And then you're also getting the valuation of the other side, getting their Excel model, getting the report that describes how they went about the valuation, and you try to find arguments why yours is better, basically. So yeah, there is usually a dispute on how damage is calculated and how much it should actually be. And that's sort of just a part of our work.
Are there any other questions? If not, we can wrap up here. Well, thank you so much for taking the time today. And I think FTI is one of our sponsor firms, so I expect that, when all the deadlines and applications are approaching, we'll definitely be sending something out. I hope this is useful for everybody. And of course, thank you so much, Alex, for her time today. And I hope it was, it was good for everybody to get an insight. And I think Ines has posted the slides, so if you want to review any of that. Okay.
Yeah. Thank you very much. Thanks for hosting. And yeah, we might have more events with the consulting society, to sort of keep an eye, and yeah, apply. Thank you.
Thank you.
All right. Bye.
Deswa, could you end the meeting?